So hello everybody, and I hope everyone is doing well during this crazy times and scary things that are going on with our health and our country and the world. So there was another scary time back in maybe 2008. You were probably pretty young, and it not so scary as it was now. It was basically a financial meltdown of a lot of the world's economy. There was no health issues, but it was still involved a $700 billion bailout. So we're going to talk about Chapter 12. We're going to talk about financial crises. Basically, financial crises are inherently interesting because they are so dramatic. And just like this was so dramatic and it happened, they happen right away. And this has become even more the case with the recent global financial crisis that has had such a devastating consequences for not only the U.S. economy, but for Europe as well. And that was in the 2008. My intent is teaching this material on the financial crises is to try to engage everyone to understand and get you more interested in what went on over that period. Okay, and again, there's a lot of YouTube videos that are available for what happened in 2008. So this chapter is going to make use of a thing called asymmetric information analysis, otherwise known as agency theory. Okay, that's when one side has more information than the other, right? We're going to explain the dynamics and adverse impact of financial crises. Okay. So Chapter 12 is going to define a lot of the concepts with regard to these financial crises. So that's what we're going to do, and we're going to find out that a large part of the financial system was flawed, and everyone was pretty much doing their own thing, including the rating agencies, Moody's and Standard & Poor's. So that's where we're going to head. Okay, that's where we're going to head. And then we'll look at maybe what's going to happen with financial regulation and to see where it goes. Now, with regard to the current financial situation, the Federal Reserve has said that they are going to throw every weapon they have to keep the American economy floating, okay? They have a lot of tools in their arsenal to keep the American economy floating. So any kind of financial crisis that occurs during your lifetime now, the Fed will be there to bail us out, okay? So again, we're going to look at agency theory. And we're going to look at how a number of past financial crises, including the 2008, most recent means the 2008 global financial crisis occurred. Okay, and I believe I sent around a couple of videos this morning that I think everyone should really watch if they get a chance as a precursor to this, because it gives you a real good explanation of what happened in 2008. So we're going to look at the term like financial crisis, right? We're going to look at that term. And basically, we'll define like 3 stages of a financial crisis. And we're going to look at what happened in, 2007 to the 2009 period that I lived through. And back then I lost about $300,000. And currently I'm down about $500,000 on the current financial situation. So let me just, if you don't mind, let me lower my phone. So after we look at the consequences and causes of that financial crisis, we'll look at what changes were made to financial regulation that developed in response to the global financial crisis of 2007 to 2009. And it's interesting because this was written before the current problem, and identify the gaps in current financial regulation and how they might be addressed with future regulatory changes. Now, the current situation is more, health related than it is financial. But the Fed is ready to act in any way they can, and even if it comes to printing money. Okay. All right. So, what is a financial crisis? And a financial crisis, it's going to occur when you get disruptions in the information flow in the financial markets. So what happened is in 2008, there were these things called off-balance sheet assets, and a lot of banks were taking mortgages, and they were bundling them and making asset-backed securities. So they took a bunch of bad mortgages, a high quantity of them, and they bundled them with good mortgages. And the rating agencies were in on the game. So the rating agencies said, okay, like Moody's and Standard & Poor's, and they basically said, all right, so what we're going to do is we're going to rate this AAA. This is a AAA mortgage-backed securities made up of a lot of mortgages. So they did that, and the real problem, of course, was that most of the mortgages were subprime, and they should not have been rated AAA. And eventually, basically, people always thought housing always went up, and interest rates started to rise, and the adjustable rate mortgages, people couldn't pay them, and they started walking away from their houses and not paying their mortgages. Thus, the economy started to crash, and for the majority of the crisis, it was based on bad mortgages and banks having bad assets. So that's what happens. And these were the financial frictions that they talk about here. And the market stopped functioning, and everyone got nervous and stopped lending each other money. Capital just dried up, including commercial paper and loans and everything. And of course, the stock market took a real slamming. All right, so a financial crisis in an initial stage, like I told you, there was a credit boom and then a bust. So basically, there wasn't enough regulation in the banks, and they were pretty much running on their own. And there was a mismanagement of the financial, the banks, right? And it was too much liberalization. And again, everything, housing always went up, and everyone firmly believed you buy a house, it goes up, and then you buy another one, and it goes up. And then eventually, the asset price, after it booms, it eventually busts. As they say, the bubble burst. And this happened with the dot-com era, and then the accounting scandal. And then there's a lot of uncertainty that goes on. As I said, people walk away from their homes and their mortgages. And then you have basically a banking crisis, stage 2, that develops because banks are running out of liquidity. And then basically there's a lot of debt floating around because people are not paying their mortgages, and they don't have any value. So all the debt is deflated, okay? Thus, banks start to fail, such as Bear Stearns and Lehman Brothers, as there were, mortgage-backed securities were crashing, and they owed big money on credit default swaps. So here's the stages. Here's stage 1, the initial phase. So the balance sheet starts to get affected here, right? And the asset prices begin to decline. And you can see there's like it drops here. There's an adverse selection, and there's moral hazard that's starting to kick in. And then the deterioration in the financial institutions' balance sheets, which causes more adverse selection. And then there's uncertainty. So everything, as you see, everything points to uncertainty and causing a lot of problems here. Stage 2 develops as economic activity really starts to decline. So we jump, to here now, right? And then there's a banking crisis, as a lot of banks are left with mortgages that people aren't paying and bad debt. So banks are stuck with bad debt. And that tends to happen. And basically, you get adverse selection and moral hazard problems worsen, so it just feeds on itself. And more economic activity, you can see it declines and the further down to here, okay? And then the debt starts to deflate, and price levels are going down, and we head into a recession. And then the Fed has to jump in, and they have to bolster the banks, of course. And they created a program called TARP. Okay, the TARP was $700 billion, and it was it was an asset relief program to help bolster the banks and keep the economy running. And in this period, economic activity still declined, right? So basically, these were causing the financial crisis, and this was the consequences of. And you can see the consequences of just one step after another. Economic activity declined, and it just kept feeding on each other there. All right, so before 2008, of course, there was as they call it, the Great Depression in 1929. And it led to the world's worst economic meltdown in history. And, my parents and grandparents used to tell me about it. The stock market crashed, and then there were bank panics, and there was a run on the banks. Everyone was going to the banks to take their money out. And stock prices continued to drop, and debt was worth nothing at that point. So there's a lot of good books on the Great Depression. All right, so I'm 12 minutes into this, so I'm going to make a part 2 because they take quite a long time, as you know, to upload. All right, so I'll do a part 2 in a little bit.